Hello and welcome to Chapter 8, Flexible Budgets, Standard Costs, and Cost Variances. I will record two parts of the video. In the first part, I will talk about flexible versus fixed budgets. Flexible could be called variable budgets, fixed could be called static budgets, and we will also, with you, set up and describe standard costs. In the second part of the video, I will cover all these different variances, and that could be quite challenging, so please pay attention. So in chapter 7, we prepared with you a big comprehensive master budget, and master budget helped us plan and control our activities, managerial activities. When you prepare a master budget, we didn't talk about it in chapter 7, we have two alternative approaches. A simpler but less useful approach is to prepare a fixed or static budget where we predict our level of activities on just one factor. So right here is just one activity level. So let's say we're making guitars and the fixed budget, I condensed it. We predict just 100 guitars, and this is the sales dollars and this is net income. So when at the end of the period we actually have the actual results, this fixed budget will not necessarily reflect a total number of units that we will produce, so it's less useful in controlling our costs, because the main function of control for management is to look at the budget, at what we planned versus at what we actually completed. And there is very little chance we're actually gonna sell 100 guitars. A flexible or variable budget is based on several different activity levels. So here we predict, what if we sell 100 guitars or 120 or 140 within the relevant range? We are not planning to produce like 1,000 guitars, and you can see there are different sales revenues, costs, and different amounts of net income. So now let's prepare a fixed budget report. This is at the end of the period. So we prepare the budget reports when we have actual results. And then we will prepare the flexible budget report, and you can see that the flexible budget report is more useful. Okay, so here is a fixed budget report. So in the fixed budget report, you can see that again, we have only single predicted amount of sales, and this is a total budget performance report. You can see we separate here cost of goods sold, selling expenses, general administrative expenses. Here is the income from operations. This is what we planned. This is the budget, and these are the actual results for the months ended January 31st. And when I start comparing them, I'm looking line by line. I start looking at variances. So the variance is the difference between the budget result and the actual result. That's what variance is. And look here, favorite variances, and guys, this will be applicable to any budget performance report, fixed or flexible. If my budget revenue is less than my actual revenue, that's great, right? It's a F, favorable variance. Or if my budget expense is higher than actual expense, that's favorable. You can take a second here. I want revenue, the actual revenue to be higher and the actual expense to be lower. And vice versa. If my actual revenue is lower than budget, I have an U variance, unfavorable variance. And if my actual expense is higher than budgeted expense, it's also an unfavorable variance. And we want to control, we want to then fix it, we want to revisit it, we want to analyze and see what happened. So if, for example, you look at sales, I made more sales, $125,000, which looks favorable as a favorable variance, but it's really unfair. I cannot make that comparison. I am comparing 10,000 budgeted units versus 12,000 of actual units I produced. And so this variance does not tell me much, because I need to bring it to the same base. And same, of course, with expenses. Right here you can see that office supplies, I spent more in actuality than what I budgeted for. So it looks like a $200 unfavorable variance. However, I produced more units, so maybe it's okay that I spent more on office supplies. So we're not going to use fixed budgets much because again they have a lot of disadvantages, and we're going to move on to flexible budget. And flexible or variable budgets, they show, like I said, revenues, expenses, operating income or net income at various levels, and including the actual level of activity. And like I said, we will prepare them for several activity levels within the relevant range, and they will reveal variances that will be more easy to analyze. They will be more practical, and they will allow us to control our performance much better. So using flexible budgets allows us to improve performance evaluation and help managers focus on problems on problem areas. So let's take a look at the flexible budget. The way we're going to prepare a flexible budget will be in the contribution margin format. We will separate variable costs from fixed costs because, again, if you recall chapters 5 and 6, my total variable costs will change in proportion, direct proportion to changes in volume, right? The more units I produce, the more variable cost we will incur. My variable costs change when the volume when my volume increases. But the total fixed cost will remain unchanged within the relevant range, so it makes sense to separate them. So here's an example. This is a flexible budget. We are producing here, so we have flexible budget, variable costs per unit, variable amounts. This is price, this is total variable costs. The difference is CM, contribution margin, and these are fixed costs, right? And then I have 3 different production levels or activity levels. What if I produce 10,000 units? And guys, again, this is produced before I actually start performance. So this is produced for the month of January, before the month of January begins. So we have 10,000 units, 12,000 units, 14,000 units. Notice that the variable cost, of course, increases, right? So if it's $4.80 multiplied by 10,000 units versus 12,000 units versus 14,000 units. And same with sales, right? So if I sell for $10, 10,000 units at $10, 12,000 units at $10, 14,000 units at $10. My fixed costs do not change, and this is my income from operations right here. So that's an example of a flexible budget. I hope it makes sense. And this is the flexible budget performance report. So this one is prepared after the fact, right? So right here, this is at the end of the month when we already have actual results. And when we look at our actual results, we see that we actually produced 12 units. So we just look at the column that was for 12,000 units. We don't need to look at 10,000 level of activity or 14,000. So we're focusing on $12,000. Again, look right here. We have the budget amount. This is what we planned for, and this is the actual production. And then we go line by line and we analyze the variance. Again, if my actual revenue is higher, it's favorable. If it's lower, it's unfavorable. If my actual expenses is higher, it's unfavorable. If my actual expense is lower, it's favorable. So with revenues, I made more revenues, and I can compare these two amounts because it's for the same level of activity. So I actually made $5,000 more in revenues, so we put an F here. And total variable cost, you see that we actually spend more. My expenses or my variable costs are higher by $1,800, and that's unfavorable. And my contribution margin is $3,200 higher, which is favorable because my revenues are much higher than my difference. My variance in revenues is much higher than my variance in direct costs, in variable costs. And then the fixed cost, I spend a little bit more, so it's unfavorable. Overall, my income is $3,000 favorable. So the idea is then to look at this in more detail. This is what we will be doing with you in a second part of the chapter, and see Well, why did it happen? Why do I have favorable and unfavorables, and who is responsible for that? Now, this is also collapsed. We're not given the huge amount of detail here, right? Because you can classify all the list separately, different variable costs and different fixed costs. So when there is a lot of level of details and there's a lot of lines, then it doesn't make sense to look at every single variance. So we apply the concept management by exception, where managers don't have enough time to analyze some small variances. They could be ignored. And we actually pay attention to only larger differences, favorable or unfavorable, and we analyze those. It's called, again, management by exception. Okay, so here is a good example of when we're given fixed budget information and we can transfer it, convert it to the flexible budget. So a manufacturing company shows the fixed budget for 20,000 units, sales, variable costs, fixed costs. And we have the actual results, but they're for 24,000 units. Again, my sales revenue, my variable cost, my fixed cost. And you can see the difference. Fixed budget is based on 20,000 units, and the actual results are based on 24,000 units of sales. We have to prepare a flexible budget performance report, flexible, and then we will label variances as favorable or unfavorable. So selling price per unit, we take $800,000 divided by 20,000 units, so my selling price is $40. Variable cost per unit, we make the same calculation. We take $160,000 divided by 20,000 units. So I have $8 variable cost per unit, and then I can apply these variable amounts to the new actual results. I don't have to worry about fixed costs because they do not really change. So again, we take sales price that we calculated, multiply by the actual level of activity, and we get flexible budget sales, flexible budget variable cost, and we use the same fixed costs from the fixed budget for our flexible budget. So I hope it makes sense. Look right here. So now I will be comparing this flexible calculated budget amounts with the actual results right here. Now they could be compared because they are at the same level of activities, which is expressed as 24,000 units. So here we are. So this is now my flexible budget versus my actual results. This is again the flexible budget, the actual results. And guys, we go line by line. My budget sales versus actual sales is favorable, right? My actual results are higher. My variable costs, actual costs are higher, unfavorable. And guys, look, my revenue, my sales variance is lower than my variable cost variance. So overall, my contribution margin is lower, which is not good, unfavorable. My fixed costs are lower, which is favorable, but overall, I have an unfavorable variance for net income. I was supposed to produce $268,000, but I produced $242,000. Again, the next question is why, and that's when we're going to start using standard costs and different cost variances to look closer to these variances, favorable and unfavorable, and why they took place. Okay, let me define standard costs and explain how this information is used. So standard costs could be used in the flexible budgeting system to enable us to better understand the reasons for those variances. And guys, so the standard costs are the price, cost, or quantity that is expected under normal conditions. They are used for planning product costs. So we will set up direct material standards, direct labor standards, and factory overhead standards. And setting standards is a long process. We have to involve the entire organization. For direct materials, we have to talk to engineers and production managers and designers. And for direct labor, we have to have a conversation with our HR as well as production managers, and for factory overhead, probably production managers. And these are benchmarks for measuring performance. They will lead us to variances. So we first set up, so you can think of standard cost same as budgets. So in budget, we look at the total amount of sales, total amount of manufacturing costs, direct material costs, overhead costs, direct labor costs. But for standard costs, it's just we express it on a unit basis. But they're pretty much same as a budget, but per unit basis. So these are my budgeted, what I plan, how much I plan to spend on direct materials, direct labor, and overhead. And there could be also standard prices and so on so far, but we're here focusing just on the standard costs for my manufacturing costs. And so some simple examples, let's say that we make pizza and we decide that like dough goes into the pizza and sauce goes into the pizza and pepperoni and cheese. And so the production team and the purchasing team, they look into how much is the standard cost for each one of those direct materials. And we have to answer the question, how much quantity do we need of each material and how much is the purchasing price? And then we determine our standard cost. And we look in the same manner, we look at direct labor. So we look at how much will it take for every pizza to be made. And then we look at talk to HR, right? Look at the labor market and we see what is the normal standard rate to pay per hour to those employees. And then we look at the production facility and we determine we look at the basis, we determine which base of overhead to use, and could be machine hours or direct labor hours, and then we determine each pizza, how much does it require, in regards to direct labor or machine hours. So these are standard costs, and as I mentioned, we have to involve many different departments, specialists in different departments across the company, and it's not just an effort of the managerial accountant, but many different teams, cross-functional teams to identify standard costs, and then you have to maintain them, right? Once you set them up, they're not going to stay static because everything changes. The rates we have to pay to our employees change, and the cost of direct materials change. So setting standard costs. Now, this is where it gets a little confusing due to the terminology. If you look at on the left, this is all about money, right? How much do you pay for direct materials or direct labor, or what kind of rate you apply to overhead. But in regards to direct material, we call it the standard price. So now we're setting standard costs that we will later compare to my actual costs. But I have to pay a price to buy direct materials, to buy that dough, to buy that sauce, to buy the cheese, to buy pepperoni. And we call it standard price, right? Which needs to be determined, SP, and also standard quantity, right? How many grams, or how many kilos, or how many pounds, what's the standard quantity? SQ versus SP. For direct labor, we don't call it price. We don't pay price for employee. We call it standard rate. It's really the same concept, right? It would be easier if you just thought about it as standard price, but we call it standard rate. What's the amount of dollars per hour we pay for the average employee that will produce this, will produce our pizza? And in standard quantity, we say how many hours, right? It might take, a half of an hour, a quarter of an hour, 1 hour to make one pizza. SH for standard hours. And guys, for variable overhead, it depends which approach we use. We're not going to focus that much on variable overhead here, but we will use here standard rate and standard hours. So here is an example. Let's say that we are making, we're making bats, wooden bats, right? And we look at, well, we need to buy wood, and how much wood does it require? So I have a standard price right here, or standard rate. and I have a standard quality or standard hours, right? And my engineering department determines, like your textbook says, that we need 900 grams, 0.9 kilos of wood, but it's for the ideal situation. So it would be an ideal standard. I need to use a practical standard, and the practical standard takes in consideration any kind of loss or possible waste. And same with direct labor. We might determine, our production manager, that it requires 1.85 hours to manufacture one bed, but we have to think about employee breaks and cleanup and machine downtime. So these are the practical standards. And so we have, again, the dollar standards, standard price or standard rate, and we have the quantity standards, a standard quantity or standard hours. So for direct material, we need 1 kilo of wood, and the purchase price, we go to the purchasing department within our company, tells us it's about $25. So this is the standard cost for direct materials. For direct labor, $20 per hour. That's what HR tells us, and we need 2 hours. So it's $40. And for overhead, we determine that we will be using direct labor hours as the base, and we will allocate $10 for every direct labor hour. So we need 2 DLH at $10, 20 bucks. So this is my total standard cost to produce one bat. And then I will be comparing this and its components to the actual cost that I will record at the end of the period. And this concludes the first part of the chapter. Thank you so much.